Donald Trump has been rebuked by the U.S. Central Bank Chief, Janet Yellen, for planning to scrap tough banking regulations that made the system substantially safer and did nothing to restrict growth or lending. Yellen, the Federal Reserve Chair, used a speech at the annual meeting of central bankers on Friday in the U.S. ski resort of Jackson Hole to warn that policymakers might have forgotten the terrible damage wreaked on the global economy in 2008 when they seek to lift regulations that prevent risky behavior. Already, for some, memories of this experience may be fading, memories of just how costly the financial crisis was, she said. The core reforms we have put in place have substantially boosted resilience without unduly limiting credit availability or economic growth. The president, who has vowed to do a big number on the Dodd Frank law at the center of banker complaints, is backing calls from executives on Wall Street and Republicans in Congress for looser financial regulations to spur growth. Trump orders Dodd Frank review in effort to roll back financial regulation. Read more in February. He said, "I have so many people, friends of mine, that had nice businesses. They can't borrow money. They just can't get any money because the banks just won't let them borrow it because of the rules and regulations in Dodd Frank." The Treasury Secretary, Steve Mnuchin, a former Goldman Sachs banker, has said a sustainable growth rate above 3% a year can be achieved once banks are relieved of the shackles imposed on them by Dodd Frank. In June, he proposed reducing the powers of the main consumer watchdog, the Consumer Financial Protection Bureau, weakening the Fed's oversight of large financial institutions, and looser mortgage lending rules. The Dodd-Frank Wall Street Reform and Consumer Protection Act was signed in 2010 by the then-President Barack Obama in response to the financial crisis. It brought in hundreds of new regulations, including tougher consumer lending rules and the need for banks to hold bigger capital reserves. Yellen said, "The evidence shows that reforms since the crises have made the financial system substantially safer. Reforms have boosted the resilience of the financial system. Banks are safer.